Liquidity. It's a buzzword that's been used to explain everything going on in the crypto market and the markets more broadly. Markets up, it's because of liquidity. Markets down, well, liquidity. So how much of a role does liquidity really play in crypto prices? A recent article by one of the top macro analysts provides the answer and what could be the key to predicting crypto prices in the future. Today, we're going to summarize that article and explain exactly what it means for the crypto market. Stay tuned. The article we'll be summarizing today is titled, quote, Bitcoin, a Global Liquidity Barometer. It was published by pro-Bitcoin macro analyst Lynn Alden, and we'll leave a link to it in the description for you folks. Just remember that there are many ways to measure liquidity. More on that later. Now, the article begins by explaining that fundamentals such as revenue are not as relevant in explaining asset prices as they once were. Instead, levels of liquidity have taken the driver's seat, with central bankers at the wheel. And this has been the case for decades, but especially since the 2008 financial crisis. For context, liquidity basically means the amount of money in the markets. When central bankers lower interest rates or buy assets like government debt, it increases the amount of money in the markets. And this causes the price of assets from real estate to crypto to rise, at least at first glance. Upon closer inspection, though, you realize that it's not the value of these assets that's increased. Rather, it's the value of the money that's declined. And this is simply because of supply and demand. The more of something there is, the less valuable it becomes relative to other assets. This is true for currencies too. Conversely, when central banks raise interest rates or sell assets like government debt, it decreases the amount of money in the markets. And this causes the price of assets to fall, at least at first glance. Upon close inspection, you'll realize that the opposite is in fact true. The assets haven't lost value, the currency has gained value. Anyways, the article explains that the result of this liquidity dynamic is that everything has become one big trade. Asset prices go up when liquidity rises, and asset prices go down when liquidity falls. And this is the case for all assets. The only difference is how sensitive their prices are to these changes in liquidity. Well, as mentioned earlier, there are many ways to skin this particular liquidity cat. For the purposes of the article, the author used Global M2, which is a, quote, measure of money supply that includes physical currency, checking accounts, savings deposits, money market securities, and other forms of easily accessible cash. In other words, the stuff that comes to mind when you think of money. The author specifies that she used the Global M2 money supply provided by Bitcoin Magazine Pro because it includes data about the aforementioned types of money from the world's 8 largest economies. Even though this doesn't truly capture the Global M2 money supply, it's a good proxy. She also adds that Global M2 money supply ought to be measured in US dollars, and this is just because the US dollar is the world's reserve currency. And this means that the US dollar has the most profound impact on all the kinds of money included in M2, both inside and outside of the US. By the way, if you're enjoying this video so far, be sure to smash that like button and subscribe to the channel and ping the notification bell as well so you don't miss the next one.
Hey man, hey, what do you do for a living?
Me? I'm a crypto YouTuber. Yeah, it's pretty fun job actually. See ya.
What about you? What do you do for a living?
Oh, me, man. I checked the Coin Bureau deals page. It's got sign-up bonuses of up to $100,000 and trading fee discounts, but I mean huge trading fee discounts, and exclusive altcoin alpha in their subscription service. Check it out.
Now, after explaining how liquidity affects asset prices and how it's measured, the author argues that BTC is the, quote, perfect liquidity barometer. Now, put differently, it has the strongest correlation to liquidity of any asset. And as you can see, BTC's price has tracked global liquidity almost perfectly over the years. But obviously, BTC isn't the only asset that exhibits this behavior. You'll recall that chart of the S&P 500 and global liquidity we showed you earlier. It's also a perfect correlation. The author underscores the fact that while this correlation exists for other assets, risk assets are typically affected the most by liquidity. She highlights the fact that most investors still view BTC as a risk asset for now. For reference, there's been lots of debate about whether BTC is a risk asset like a tech stock or a safe haven like gold. The silver lining to BTC still being a risk asset is that it makes it easy to forecast its price using liquidity. As for gold, the author points out that its correlation to liquidity, well, it's kind of mixed. Gold goes up when liquidity is rising, mostly because currencies are losing value. And gold also goes up when liquidity is falling, and mostly because there's a flight to safety by investors. And this is why gold has been going slowly up and to the right. BTC has also been going up and to the right over time, but its sensitivity to changes in liquidity has made its price extremely volatile. The trade-off is that BTC has experienced significantly larger gains than gold, and if you watched our video about BTC versus gold, you'll know that BTC has risen by more than 760,000 times since 2009. More about that in the description. Now, this begs the question of just how much liquidity actually impacts Bitcoin's price. The author reveals that the answer depends on the period you analyze. For example, between May 2013 and July 2024, BTC's correlation to global liquidity was 0.94 out of a possible 1, so an almost perfect correlation. But when you start looking at averages, the picture looks a bit different. For instance, BTC's correlation to liquidity falls to just 0.51 on a 12-month rolling average and as low as 0.36 on a 6-month rolling average. Logically, this means that BTC's shorter-term price action is affected by other factors. What's interesting is that while BTC still has the strongest correlation to global liquidity compared to other assets on a 12-month rolling average, it has a lower correlation to global liquidity on a year-on-year basis than other assets like stocks in emerging markets. Naturally, this is because every 3 to 4 years, BTC has a massive drawdown of 60% or more. And as a fun fact, this is typically caused by crypto leverage. Anyhow, although BTC doesn't have the strongest correlation to global liquidity across all time frames, the author argues that it is nonetheless the most correlated to global liquidity overall. And this is because BTC is, quote, directionally aligned with global liquidity. They almost always move together. Even so, the author stresses the fact that this directionality boils down to the time frame. In the longer term, BTC is strongly correlated to levels of global liquidity. In the shorter term, BTC tends to be influenced by other factors, such as the German government selling BTC. Not going to make it. Jokes aside, the author then takes a closer look at how these, quote, idiosyncratic events have affected BTC's price over the last decade. Not surprisingly, bearish catalysts like the collapse of Mt. Gox and the deleveraging events like the collapse of Terra's UST stablecoin have historically tanked BTC's price. Surprisingly, the author believes that these idiosyncratic events will become less common over time, and some would argue that they will continue to happen a lot, and that's because there will always be an entity somewhere taking on way too much leverage with BTC. One publicly traded company does come to mind. In any case, it's not just idiosyncratic events that have caused BTC's price to deviate from levels of global liquidity. There have been many instances where BTC's price decoupled from global liquidity to the actual upside. Of course, these include 2013, 2017, 2021, and probably 2025 if the 4-year cycle continues. The author refers to these positive deviations as, quote, supply-side dynamics. And this makes sense when you realize that levels of liquidity are effectively the demand side of the equation. It's ultimately the shortage of BTC for sale that causes its price to go exponential during crypto bull market peaks. The author notes that the people selling BTC near its cycle tops tend to be long-term holders. On the flip side, the people buying BTC near its cycle tops tend to be short-term holders, who are the first to panic sell when its price plummets. And this dynamic makes certain on-chain indicators very useful. For those unfamiliar, one of the most popular on-chain indicators is Bitcoin hodl waves, which show you how long wallets have been holding BTC for. The author looks at Bitcoin's one-year hodl wave, which measures the percentage of BTC's supply that has been sitting idle in wallets for more than a year. Newsflash, but those holding BTC for more than a year are long-term holders. And lo and behold, the one-year hodl wave tends to fall off a cliff when BTC hits all-time highs. Again, that's because long-term BTC holders are selling their coins to the short-term BTC holders, aka the crypto tourists. It's worth noting that BTC's one-year hodl wave has started falling, but it hasn't fallen off a cliff as it has in previous cycles, at least not yet. And this is additional evidence to the idea that BTC's all-time high for this cycle is still ahead of us, and that these highs are likely to occur sometime in 2025. Now, another on-chain indicator the author analyzes is called the Market Value to Realized Value Z-score, or MVRV Z-score for short. But don't panic, she breaks it down in plain English. First, there's of course the market value, which is just the current market cap of BTC. And as you know, this is measured by multiplying price by circulating supply. And I'll quickly note that it's fundamentally the market cap that determines how much a crypto can pump, and not its price tag. The smaller the market cap, the more a crypto can pump regardless of its price tag. Now, second, there's the realized value, which is measured by taking the average price of all the BTC that's been moved between wallets and multiplying it by BTC's circulating supply. What this component of the indicator tells you is essentially the average price at which people purchased BTC in a given period. And finally, we have the Z-score, which measures how much BTC's price has deviated from the realized value. As you might have guessed, what the MVRV Z-score measures is what percentage of BTC holders are in profit. The higher the MVRV Z-score, the more unrealized profits the average BTC holder has. And as you might have also guessed, the MVRV Z-score tends to peak around BTC marked tops. What you might not have guessed, though, is that the MVRV Z-score tends to decline sharply when BTC's correlation with global liquidity falls to the downside. The author makes an actionable observation here. In short, shorter-term traders need to watch the MVRV Z-score when assessing BTC's future price action. If the MVRV Z-score is very high, then that suggests that BTC's price could fall even if liquidity is rising. Alternatively, if the MVRV Z-score is low, then BTC's price will likely rally in line with global liquidity. The fact that the MVRV Z-score is still fairly low is further evidence to the idea that BTC hasn't experienced its blow-off top yet, and that this might not happen until 2025. More importantly, it suggests that BTC's price will continue rising with global liquidity for the foreseeable future. In the conclusion, the author reiterates that BTC's correlation to global liquidity is very strong, but not perfect. There are periods when crypto-specific factors take over and cause BTC to decouple from global liquidity to the upside or to the downside. And on-chain indicators can be used to assess this decoupling. A sharp decline in the one-year BTC hodl wave can give us a sense of when BTC has decoupled from global liquidity to the upside. And a sharp decline in the MVRV Z-score can give us a sense of when BTC has decoupled from global liquidity to the downside, a top and bottom signal respectively. To her credit, though, the author cautions that these indicators cannot perfectly predict BTC's price action. She even cites a saying in statistical analysis, quote, "All models are wrong, but some are useful." In this case, the reference is to global liquidity, which is increasingly becoming the explanation for everything in crypto. And this brings me to the big question, and that's what all of this means for crypto. I'll start by saying that it means a lot, even though this article was about BTC. And that's because most of the crypto market follows BTC, and altcoins are even more sensitive to liquidity than BTC. That said, liquidity isn't everything. If you imagine liquidity as a literal liquid that can flow in and out of asset classes, it's easy to picture barriers to these liquidity flows. The main reason why BTC is so sensitive to global liquidity is because it doesn't have many barriers. Liquidity can flow to BTC indirectly via ETFs or directly via crypto exchanges. By contrast, most altcoins trade only on decentralized exchanges, statistically speaking. In practical terms, this creates lots of barriers for liquidity to flow to these altcoins. Picture the pathway involved. Liquidity needs to flow from the central bank through TradFi and into crypto to get to the altcoins. Historically, once this liquidity made it into BTC, it would easily find its way into altcoins. But ever since the launch of spot Bitcoin ETFs, it seems that less of this liquidity is leaking into the rest of the crypto market, and many analysts have pointed this out, but it misses the bigger picture. For starters, the spot Bitcoin ETFs did not take any liquidity from the rest of the crypto market. All they did was add additional liquidity to BTC. In theory, this won't benefit altcoins in any way. In practice, it looks like it will, and that's because of the same factor that eventually causes the crash, and that's leverage. You see, the spot Bitcoin ETFs have increased BTC's price to substantially more than what it should be at this stage in the cycle. It's safe to assume that this trend will continue, meaning that BTC's price will continue to be substantially higher than what it would or should be without the spot Bitcoin ETFs. If you think about it, this makes BTC the ideal form of collateral in crypto. That's because the ETFs mean that it's very easy for any new liquidity to flow into BTC compared to other cryptos. In case you missed the news, there's been a huge increase in wrapped BTC on Ethereum, namely via Coinbase's CBBTC. Not only that, but there's a growing number of Layer 2s and DeFi protocols that leverage Bitcoin and BTC. What this means is that there's likely to be lots of borrowing against BTC across multiple blockchains. It goes without saying that this BTC will be used as collateral to buy altcoins via borrowed stablecoins. Now, let's assume that BTC hits a market cap of around 3 trillion, and let's assume that around 10% of BTC's supply is used as collateral to borrow in DeFi protocols. This could mean hundreds of billions of dollars flowing into altcoins, a liquidity that's coming indirectly from BTC thanks to the ETF boost. It's not just BTC either. It's easy to forget that ETH has a spot ETF of its own too, particularly because the inflows have been so lackluster. Consider that the presence of the spot Ethereum ETFs make it very easy for liquidity to flow from BTC into ETH, and this has the potential to give ETH an even bigger ETF boost. And because ETH is currently the most popular form of collateral in DeFi, a substantial increase in ETH's price means that there will be a substantial increase in borrowing using ETH as collateral. If ETH is indeed following BTC one cycle behind, then Ethereum could hit a market cap of over 1.2 trillion in this cycle. Assuming around 10% of ETH's supply is used as collateral to borrow in DeFi protocols, this would add tens of billions of dollars of liquidity flowing indirectly to altcoins from ETH's ETFs. Now consider that there are dozens of other chains like Solana, which will have billions of borrows against their native coins too. When you add it all up, there could be up to $500 billion of liquidity coming from DeFi borrowing, most of which would be a byproduct of supercharged BTC and ETH prices. To put things into perspective, this could account for more than 5% of the total crypto market cap if it hits $10 trillion. Never mind the hundreds of billions that are likely to be borrowed against BTC and ETH off-chain. As we've learned, though, all this leverage will eventually result in one of those idiosyncratic events. Something will happen that causes the price of BTC or ETH to fall sharply, triggering liquidations of over-leveraged entities. This will result in forced sales, resulting in more liquidations, and so on and so on. Thankfully, though, the crypto market is in the early stages of this process. Over the next year, we're going to see a march higher in line with liquidity before deviating to the upside due to those supply-side dynamics. The best part is that people will finally stop obsessing over levels of global liquidity. Come to think of it, maybe that's when we'll know that the crypto market top is in. And that's all for today's video. If you learned something new, be sure to smash that like button. If you want to keep learning, subscribe to the channel and ping the notification bell. And if you want to help others learn about the facts and fictions of global liquidity and crypto, be sure to share this video with them. As always, thank you very much for watching, and I'll see you in the next one. This is Nick, out.